All right. Hi, everyone. This is Rob Barnett from Bloomberg Intelligence, and I'd like to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in the market. Today, we've got a special guest. Our colleague in the U.S., Mike McGlone, has graced us with his presence, and we asked him just about 15 minutes ago if he'd want to join, so he's really hopped in, and he's got a really interesting note out today that I thought it would be fun for us to chat about. He published his 2022 commodity outlook, and Mike, we're going to start with you. I want you to give us your lay of the landscape for 2022 commodities broadly, and then we might dive in, talk about some of the fundamentals and compare and contrast. I don't know if we 100% see eye to eye, but that's great. It's good for our clients to hear some of that tension. So tell us about your sort of broad view.
The higher price cure should kick in, Rob, and I think that's the cool thing about what we do in Bloomberg Intelligence is we have to disagree. We're encouraged to disagree and let our readers decide, because we're not pushed by any form of management to have a view, which is what I have enjoyed in my short career in markets, and that is. So my view on commodities is clearly next year is going to be more about reversion. The first question was, has crude oil peaked? I think yes, the market's proved it's peaked. When you have coordinated SPR releases, I have to give kudos to Mr. Biden for selling high and Mr. Trump for buying low. That's very rare, as we all know. You got to smile at that one. All right, good. Our presidents are now trading commodities and trading crude oil, but it's a fact of what's happening in the macro, and that is, I really enjoy I was just on with our metals team in BI, and I really enjoy being in BI now with the energy team, because you guys dig into the trees, and I'm the macro, and I see WTI crude oil, Brent crude oil, half the price from the peak for a good reason. I see copper the same price, and corn and soybeans the same prices over a decade ago for a good reason. And during bear markets, because of elasticity of supply and demand, and I fully expect those forces to really kick in next year, most notably in crude oil. And I'll leave you with this. The key thing I've been watching for most of the last decade is this declining process of U.S. going from the largest customer of OPEC, the largest importer on the planet, to a net exporter. Next year, back to net exporter, completely on the back of one key fact: higher prices and increase in innovation. So I don't see a good upside for crude oil. I see all commodities heading lower. And if we just get a little blip in the stock market, the whole thing, just a little mean reversion of this uninterrupted rally we've had in commodities since the 2020 boom, is really scary to me. And I have to admit, as a commodity guy, I hate being bearish, but I have to point out the facts. And that's what helps us at BI. We have to just get it right.
Mike, I'm sharing my screen right now. Not sure if you can see it, but this is a fun chart that I sort of discovered myself a week or so ago, and it shows crude oil, Brent crude oil, in the blue line versus European carbon credits converted into dollars. And it's interesting to note that a European carbon credit is now more than a barrel of oil. So I know they've got different denominators and all that kind of thing. When you've got a relatively bearish view when you look at the sort of broad commodity cycle, do you think carbon's a standout? And how do you think of that interplay between oil and carbon?
Yeah, carbon's a bull market. I love the carbon credits. It's a bull market. Crude oil's the opposite. It's the old guard replacing the new. And I don't know much about carbon credits. I did when I helped update some technical outlooks a couple months ago. I haven't watched it lately, but I see a bull market. I see it kind of things like I see during bull markets in Bitcoin and Ethereum. And I see carbon, the credits the same way. And the key thing we had to ask ourselves is, what is elasticity in supply and demand going to do to the price of carbon credits? That's a question for you guys in the team. You dig in more than I do, but I see a bull market, and I'm just kind of naive about that stuff. Yeah, there'll be a correction, but dig in and give me the details so I can learn with our audience.
I mean, the interesting thing about the carbon market, in my view, is that it's really could soar or dive based on the whims of policymakers. So it's a little bit unique in that sense, although you were mentioning the whole dynamic of U.S. presidents and SPR releases. So I guess there is a little bit of potential political intervention as well. One of the sort of factors that's been helping to support prices here in the near term is the German government's talking about putting a price floor on the carbon market. But all right, let's bring on a couple of our other colleagues here and get some discussion going. We'll go to Salih first. We've got an OPEC meeting tomorrow, and they're certainly going to be thinking about some of these same exact factors. You know, what's their expectation on the market, and where do you think they're trying to guide prices to?
Sure. Thanks, Rob. And it's really great to have Mike on today, I must say. So this OPEC meeting is actually, I think, too close to call. So we really don't know what will come out of it tomorrow, which makes it very interesting, but also makes the oil market quite volatile. I mean, we've seen oil prices come down by about 15% between Friday and Tuesday, and then today they're up by about 5%. And I think we should expect some more volatility for the rest of the year. And I think what makes the task at hand for OPEC a little bit more complicated than perhaps before Omicron is, the SPR release to begin with. I mean, this is something that initially they said that changes the dynamics of the oil market and they might have to respond to. But then before we had the Omicron variant, if they had responded to it by saying, okay, we will actually pause our 400,000 barrels a day of output hikes in January, that could have been seen as a direct response to the U.S. and could have started essentially a diplomatic spat between the two groups. But then with the Omicron variant and the uncertainty around what it will mean for the near-term oil demand, I mean, they postponed their technical meeting from Tuesday to later in the week, and I think their analysts are really working hard to put some numbers on what the impact may be. And with those two combined, I think the likelihood of them actually pausing for January and potentially for another month or two have risen significantly. So again, I don't really want to make a guess here because it's really too close to call. But I think they are very busy right now trying to see what the demand impact will be. And I think they know this is very much a jet fuel demand issue at the moment because we are seeing some countries bring back travel restrictions and some partial lockdowns, which really is going to hit jet fuel demand the most in the beginning. So, it's definitely one of the, we keep saying this for the last few OPEC meetings, that this one is an interesting one. But really, this is actually the 11th OPEC meeting this year, which is the most they had ever. And I must say, most of them have been quite interesting, at least to me.
Thank you, Salih. Be watching the BI Wire tomorrow. Both Salih and will certainly have some commentary and analysis once we get some of the decision making. Will, I want to go to you next. Salih was certainly talking about the idea of the latest coronavirus variant, how it's affecting demand, travel recovery. But when you look more medium term, what's your expectation for where demand could be headed? What about the rise of electric vehicles? And I would just note that I think, and I'll let you correct me if I'm wrong, is that BP is aiming to reduce oil demand their own oil production rather, something like 40% over the next decade or so. Is that because they buy into this green energy transition? Are they viewing weak demand signals? Do they believe Mike's more bearish outlook? Give us a sense of how you read the tea leaves.
Yeah, sure. Thanks, Rob. So I think to the first part of your question, near term, we remain pretty constructive on demand. We think the pressure that we've seen in Brent, down 15-20% in the last few days, is overdone. This is obviously conditional on the spread of Omicron, but I think as Salih pointed out quite aptly that the primary impact will be on jet fuel demand, and that's roughly 8% of global oil demand. So we think this near-term pressure that we've seen will sort of work itself out. And next year we continue to see pretty positive indicators for demand, further recovery from COVID, continued vaccination plans helping stem more serious, full lockdowns that we saw at the beginning of last year. So I think through next year we are quite constructive on demand. We think supply on the other side of the equation can remain relatively controlled by OPEC plus. A certain possibility coming from this meeting this week will be a pause or a delay in their 400,000 barrel a day increase. Meanwhile, non-OPEC supply remains weak. We've seen significantly reduced capex in upstream as a result of the pandemic, and we've also seen a big push from U.S. shale investors demanding dividends and buybacks over investment and operational growth. So I think with these two factors, both constructive on demand, control on supply, this is a relatively bullish outlook through next year. And just quickly on the BP side, yes, that's correct. They've committed, or their ambition is to reduce their upstream oil and gas production by 40% by 2030. This is the most dramatic energy transition policy of the global oil majors, and I think it really reflects a rapid transition for the company. And I think this can be attributed to really two elements. One is that the company is a relative latecomer for energy transition planning, and this is largely due to the company's new CEO, which just joined in February of last year, and has really undertaken an enormous strategic overhaul, the biggest in the company's over 100-year history, to catch up, I think, to some of their European peers who have been, investing in renewables for a lot longer than they have, and also reducing emissions, which is a key part of this 40% production target that management has talked about.
Thank you, Will. I'll just highlight for anyone listening, tomorrow we've got our latest BI survey. Maybe some of you actually participated in it. It's for our clients, and we ask them all sorts of fun questions. One of the questions we regularly ask is, when do you think oil demand is going to peak? And, we get a different answer every time, but what I would say is that, at least based on some of our past work, a lot of our customers and clients, when we ask them, we kind of see something in the range of 10 to 15 years, which I think is roughly aligned with how a company like BP is thinking about it. So Mike, I want to come back to you. I'm on the sort of side of the equation where we see a lot of structural change being driven by electric vehicles, things like that. At least in the medium to longer term. I think you're a kindred spirit there. So, is that playing into some of the way you're reading the commodity cycle? And if people are going to buy less oil in the long term, or the medium term and long term, because they're driving more EVs, what does that mean for some of the other metals and things like that go into producing electric cars?
Well, I think we really get a good example of how we in BI have really good discourse. It's not disagreement, discourse. And Will and I are a little bit on the opposite end of this. U.S. crude oil, liquid fuel consumption is the exact same as it was 20 years ago. It actually peaked about 10 years ago. And it's only because of efficiency. That's never happened in the history of the world. Now, I have to use U.S. as an example because the world's former largest demand pull source of liquid fuel is now an exporter. And that's total liquid fuel. I come from a farm background. Almost 15% of total unleaded gas now is from ethanol. And still, prices are like soybeans are still down in the air. Still, we have to add a lot of biofuel. There's tons of potential supply coming on there. So The key thing is EVs are kicking in. Yes, I've owned an EV for 7 years. And once you get an EV, you'll see you won't go back. As Kathy Wood says, within 4 years, the average EV in the world is going to be cost effective with an actual internal combustion engine. That's a game changer. And your average range will be well over 300 miles. The average person doesn't drive more than 300 miles in one clip. Now, I got a poor man's Tesla, Chevy Volt. It's great because I never have to worry about range anxiety, and recently drove it all the way from Connecticut to Florida, 1,400 miles. And it's just amazing, the technology. It's so much better. The point is, crude oil, liquid fuel production in the world, in the U.S. is now heading downward. And I point to the U.S. because, yes, what's happening in China? Shifting to EVs rapidly. Where's the other source of incremental demand in the world? China. What's China right now? In decline. Cyclical decline. We've been pointing this out for a while. The cut in the triple R rate has been a good sign. The property issues, all in decline. And then we have a political leaders that are going inverted. They're basically call the president, but becoming more and more dictatorial, as Mr. Z is. That's really bad for the whole lifting up of demand and lifting up of your average GDP per person in China. So I view China as in decline. I view the U.S. as a great example of declining demand for liquid fuels, alternative sources, and this transition towards renewable sources is accelerating. This is the first time since the plunge in 2014 that we've actually had higher price incentive. It's all happened with just prices, with lower prices. Now we got higher price incentives. So I look at it, the macro is, this is, like the oil companies absolutely replaced the harvesting of whale oil. Now the oil companies are being replaced by technology. It's a macro, but the shorter term is the supply is coming. I look at the grains as an example. Corn, soybeans are up 30% on the year. Supply came on. It can happen quickly in grains, and now they're down 6%. That's what I expect to see in crude oil. It just takes a little bit longer.
Well, it's interesting you mentioned the U.S., but I would point out that Europe is already seeing some pretty big structural declines in oil in some of the markets. If you look at the UK, Germany, the oil demand has not jumped back up to its pre-pandemic level. It's still covering quite a bit low, and it can't be explained just by the lack of jet fuel barrels that we know are missing from the market. So we think there are really some interesting things happening there. The UK share of electric vehicles is rising every month. Anytime I look, I'm sort of staggered by how high it's at. So we're seeing some pretty big shifts over here. But, at this point, we're not running all of our grids on wind and solar, and we actually have a fossil input to the electricity grid. And I know it's not as much of an issue in the U.S., but we are in the midst of a gas crisis here in Europe. And I want to bring on Patricio to get his thoughts on that. But before we talk to him, maybe just how do you see gas in the mix just globally over the next year? Where does it fit within your sort of commodity crystal ball?
Fair market. The natural gas has been led in the whole world by U.S. massive advancing supply in the U.S. We just had this recent bounce to near 6. That's the same price as 1997, I think. Gas peaked around 12, I think it was 2005, and right now we're about a third that price, finally below 5. And the market, just like the grains in May had priced for a bad supply year, natural gas pricing for a cold winter in November is a real bad sign. And the steep backwardation we saw in all the energies is just a horrible sign for future prices. If you look at market, typically goes back down to that 1-year curve, which is priced lower. So I look at U.S. natural gas, the leading indicator for the world. These suppliers could not wait to bring on more supply, and they had the highest price incentive in a few years to do it. So from a U.S. standpoint, where the incremental supply is coming from, and the market would collapse here without LNG exports, it's just coming on. And people in Pennsylvania were just saying, thank you, we could not wait to bring on more supply. And you let us sell forward a year and lock in prices at double the cost of our production.
Well, I think a lot of folks in Europe wish that they could breathe a sigh of relief and have that same outlook over here. Patricio, where are we at when you think about the European market? How do storage levels look, and are we where's the supply-demand balance at the moment over here? Because prices are still pretty elevated, at least in the short run.
Yeah, so in terms of the storage part of the equation, which is a significant part of the supply equation at this time in Europe, given the ebbing pipeline flows from Russia this year, storage levels are at around 64%, which is nearly 15% below the 10-year average. So those are worryingly low at this stage, with the EU lawmakers already speaking of intermittent blackouts, which were not on the table. Although I would like to highlight our colleagues at BNEF have produced a scenario analysis where they say if the winter is colder than the average of the past 30 years, if it's colder than 80% of the average, then we could go down to near 0% storage levels by the end of this winter. And although we see that as unlikely, this narrowing of the storage going into next year could form sort of structural tailwind for gas prices here in Europe. You have to remember that Europe has almost no indigenous production, so we're highly dependent on LNG imports and the pipeline flows from Russia mostly. So this means that next year could see, although we don't expect the same type of volatility, this need to replenish the increasingly low storage levels at high prices will probably mean that we will see this low storage levels on average extend into next year. So that sort of gives you a sense that this could have this gas crunch could have implications beyond this winter.
Patricio, while we've got you on, also in commodity-related developments, the the German government is now talking about a coal phase-out in 2030 instead of 2038. So they pulled that forward. How does that interplay with gas, and what does it mean for some of the major utilities in the European market?
Sure. So I think on the first point, this is definitely a good sign for gas demand, at least in the midterm. So we're talking about 2022 to 2025 maybe, because it will accelerate the coal phase out in Germany, which is one of the major, the dirtiest consumers, I'd say, like in generation wise. This will pull things forward, and it will impact utilities, especially RWE, because that's sort of the German renewable champion. It will allow the company to dispose of their coal assets faster, which I think they're operationally ready to do. And so that should play into and translate into modest growth for the renewable capacity targets through mid-decade. And the other utility that could benefit from this is Uniper. This is a more traditional generator in Germany with a significant size in gas production and gas generation. So this could have a positive read-through for gas demand in the midterm, which could improve the usage levels for these two companies.
Very interesting. While we're talking about company-specific news, I want to come back to Will Hares. Will, you put out a react on looking at Lundin and potential sale of the business. So tell us what your initial assessment is, and anything you want about that development.
Yeah, sure. Thanks, Rob. So just for those that are unaware, Lundin is one of the largest independent E&Ps operating in Europe. It has an exclusive Norwegian operating portfolio, and its current market cap is around 11 billion. And so it really is, or it would represent one of the largest sales in upstream in Europe for many years. And our take is of their reported interest in a sale is that this company has one of the most energy transition portfolios in upstream available. It has extremely low carbon intensity, so it's about 2.5 kilograms of CO2 per barrel. This compares to the global average of somewhere around 20. It's got very low cost production, and it's got a strong growth visibility with its mega project Johan Sverdrup Phase 2 coming on late next year. So as you might gather, this is a premium upstream portfolio. And we think that it will demand a fully valued offer. An important consideration here is that the Lundin family is a 1/3 owner of the company, and we think that a share offer is unlikely to be accepted. Don't think this company would really look kindly on trading their Lundin shares for another oil company's, and so we would expect a premium value cash offer for the company if this does go through, but that really narrows down potential suitors. We don't think this is, or the size of this deal would exclude private equity. We think it definitely excludes their independent peers. The U.S. majors have not signaled any interest in expanding globally. They're instead doing the opposite, pulling back to stateside. Most European majors are probably unlikely to be interested in as well, with one exception, we think. Total Energies already has a small interest in Lundin's core mega project, Johan Sverdrup. So there's this compelling operational overlap and potential synergies there. And then Total has also shown an interest in bolstering and growing its North Sea production footprint with its recent Maersk Oil, or its Maersk Oil acquisition a few years back, and it also has balance sheet capacity, and so it would definitely be a major event if Lundin did get sold, and we're going to be keeping an eye on it for what happens here.
Thank you, Will. All right. So one thing that we just put out this morning is a look back on our predictions for 2021. This is a sort of fun note that we put out at the end of every year, going into the next. And I would just pat ourselves on the back. We had some pretty good calls this past year, looking at everything from the share of capex at the European oil majors that would be allocated to energy transition programs. We looked at the recovery in oil demand and whether we would get back to the pre-pandemic level, a number of other things. Check out the note. We hold ourselves accountable, so we go back and revisit each idea and sort of question ourselves: did we get it right? Will we, or did we miss something? So take a look at that and keep an eye on our outlook for 2022. But with that in mind, we got a couple minutes left, and I just want to quickly run through everyone one last time. As you look into 2022, what is one of the most exciting themes or topics that you're going to be watching? We'll come to you first, Salih, and then we'll just go down the line. So, Salih, what are you watching for 2022? Just real brief.
I'm not sure if this is exciting, but kind of exciting in the sense that it can be quite a big catalyst for oil prices. I think is how, especially after the SPR release that we saw that was done collectively between U.S. and other oil-consuming nations. I think, and I do have to disagree a little bit with Mike here, even though that's very rare, is that I think we may be looking at, beyond the Omicron variant, we may be looking at a very resilient demand outlook that's supported by jet fuel, that's supported by petrochemicals. And don't get me wrong, in the very long term, I do agree with Mike, but I'm just looking at the next year for this question specifically. And I think if we do look at a positive demand outlook, and at the same time we have some SPRs released, less strategic reserves, inventories that are not necessarily much higher than where we have them right now, and lower spare capacity by OPEC, I think this really sets the stage for potentially higher oil prices with less tools in our hands to respond to it with. Again, I don't think that this is very exciting. I mean, maybe it's exciting if you're an oil bull, but that's definitely one thing that I will be watching very closely next year.
Thank you, Salih. Will, Hares, what are you watching for 2022? What's the big theme?
Yeah, I'm not sure if it's a theme, but I'm definitely going to be watching for more activist investor pressure among European oil majors. We've seen obviously that major push by engine number one to get two board members on at Exxon. We've seen similar attempts not to push for board members, but for to push for increased disclosures and strengthen targets on emissions across the European majors. We've just seen Dan Loeb's Third Point fund calling for the breakup of Shell given its underperformance. So we think these this underperformance side and ESG pressure is definitely coming to a head for this sector, and I'll be watching out for any more of that next year.
Fantastic. Patricio, what do you got on deck? What are you watching for 2022?
I'll remain focused on natural gas prices going into next year. So I think that the most interesting piece I've seen lately is that Gazprom expects natural gas prices in Europe to remain at least as high as in 2021, moving into 2022 on average. So I think that's a fascinating take if you look at it in the context of the recent volatility. So I'm going to be closely looking at how that plays out, and this will be a combination of tightening LNG demand and prices driven by Asia, and probably as well a good proportion of new long-term contracts linked to oil prices. So that's the main theme, I think, for me.
Mike McGlone, what are you watching for next year?
I think we're going to see a reversion towards the massive, more significant trends that have been pressuring commodities for the last decade. Crude oil prices lower. Soybeans have been a good example. They were up 30% on the year, and they're down 6%. Following the lead of what the long bond's telling us is 1.81%. That's the U.S. I think U.S. yields are going to follow what I saw started in Japan 20 years ago and Europe 10 years ago and go negative. And there's one key thing that I'm worried about, and that's just a little normalization in the U.S. stock market. S&P 500 can't go up an average of 25% a year without some normal reversion. The Fed's starting to prick that. Chairman Powell now has a little bit of renewed reason to do that. He's been reappointed. So what I see is a return back to away from the distortion of 2021. And what I'm fearful in commodities when a little mean reversion can look like a crash. What was 1987 in the U.S.? It was a crash, but all it did is the stock market ended up a little bit on the year. It was just too expensive. That's what I'm worried about in commodities, overall markets. And the key trigger is if this U.S. stock market can advance another 25%, great. If it just gives back 5%, I see crude oil heading back towards the longer-term cost of production in the U.S., which is below 50. I see copper's probably peaked. I see corn's probably peaked, and that's just not profound. Those are the bigger picture trends. And I want to also, and then this one key, very profound note, Rob. I love the look of when Patricio came on. We could see you in the background. You look like the Wizard of Oz because we're like your minions. We all have these collared shirts on, and you got that look. So I just want to thank you for that, and I appreciate you having me on. I appreciate the views of my colleagues because it really helps us to have this discourse. It makes it better for us and for our viewers.
Mike, are you in Miami right now? I think you are, correct?
I have moved permanently to Miami, so I have a long bike ride. It's really rough.
I'm dressing for the Miami office, so I've embraced the style there. By the way, I didn't get to share an idea from me, but I would say watch what solar demand's going to do in 2022. We think it could grow something like 15 to 30% next year. It's an exciting year if oil demand grows 1%. Solar demand growth is a true hockey stick. If you've never seen the chart, check it out. We are very optimistic about demand growth for wind and solar, but solar is going to have a great 2022 in our view. Got great read across in the company, so check out our research on that. And I want to thank everyone for joining today. This has been a fun call, and shoot us an IB if you've got any questions. We're all on the terminal. We're very happy to chat about our research. And of course, you can find everything that we've been talking about. You can go find the research itself by visiting BI Go, and I hope you have a great afternoon. Talk to everyone soon.